Hello everyone, in this video I'll be sharing my top stock picks for 2026. Over the past few weeks I've analyzed the balance sheets of more than 250 companies and ran detailed projections on them using my stock prediction model, and I narrowed the list down to 33 companies that in my view are exceptionally well positioned both fundamentally and technically. So for this video I'll be covering my top 10 picks and I'll break down the remaining names in follow-up videos so we can keep this one focused and easy to digest. I'll walk you through each one, explain why they made the list and break down the numbers behind the thesis. So without wasting any time, let's get straight into the list. The first stock on my list is Sea Limited, ticker symbol SE. Sea Limited operates three major businesses and each one plays a very different role. First is their Shopee business, which is their e-commerce platform. Second is Money, which is their digital financial services business. And third is Garena, which is their digital entertainment and gaming segment. They are diversified across e-commerce, fintech, and entertainment. Right now, Sea Limited has a market cap of about $83.9 billion and their revenue is growing at roughly 35.8%, which is extremely strong, especially for a company of this size. If you look at their most recent quarter, you can really see where the growth is coming from. Shopee, their e-commerce business, brought in $4.3 billion in revenue. Money, the digital financial services arm, generated $990 million. Garena, the digital entertainment business, contributed $653 million. So, Shopee is clearly the main growth engine here and it's growing incredibly well, while the other two segments are adding diversification and stability. Now, let me tell you how I personally look at this stock. I use my own valuation model where I factor in current EPS, expected annual EPS growth rate, and the current PE ratio. Based on that model, this is what I see. About 25% upside over the next 1 year and roughly 205% upside over the next 5 years. For me personally, before I invest in any stock, I never rely on just one thing. I look at projected prices, their balance sheet, and the technical setup. And just to be clear, this is not a recommendation. You should always do your due diligence before investing in any asset. With that said, now let's move on to the balance sheet because this is where Sea Limited really stands out. They currently have $5.13 billion in cash, $9.9 billion in cash equivalents, and total debt of $4.24 billion. When we add all those up, that gives them net debt of negative $10.8 billion, which means if Sea Limited decided to pay off all their debt today, they would still be sitting on $10.8 billion on cash. That's an extremely strong position to be in. On top of that, they are generating about $4.27 billion in free cash flow per year, which is fantastic for a company at this stage of growth. So fundamentally, this is a very strong business with plenty of cash, low risk on the balance sheet, and solid cash generation. And even technically, if you look at the daily chart, Sea Limited is currently trading below its 200-day EMA. So for long-term investors, this is often considered a very attractive entry zone. And this is exactly why personally I've been selling cash secured puts on Sea Limited every week. I'm not chasing the stock, I'm letting the stock come to me at levels I'm comfortable owning for the long term. So when you combine strong fundamentals, a clean balance sheet, solid free cash flow, and a favorable technical setup, Sea Limited becomes a very compelling long-term play in my view. That's why Sea Limited earns the first spot in my 2026 checklist. Alright, now let's move on to the second stock on my list, that is Shopify. Most of you might already know what Shopify does, but let me still set the stage properly. At its core, Shopify is a commerce platform that allows businesses of all sizes to start, grow, and manage their businesses. Whether a merchant is selling online, in physical retail locations, or across multiple channels, Shopify basically acts as the backbone that makes all of that possible. But here's the thing, Shopify is no longer a basic e-commerce platform. They are now heavily focused on something they call agentic commerce, which is essentially commerce powered by AI agents. They have built tools like Catalog, Universal Cart, and Checkout Kit, which allow AI agents to help consumers shop seamlessly across Shopify merchants. So instead of you manually searching, comparing, and checking out, AI can actually do a lot of work for you in the background. And that's a massive shift in how online shopping will work over the next few years. Now, let's talk about how Shopify actually makes money. Shopify generates revenue through subscription-based platform services and transaction-based merchant services, including Shopify Payments and Shop Pay. And this model has been working extremely well for them. Right now, Shopify's revenue is growing at about 30.25%, and the company has a market cap of roughly $217.9 billion. Using my valuation model, I'm seeing about 25% upside over the next 1 year and roughly 202% upside over the next 5 years. That would put the stock around $500 in about 5 years if execution continues the same way it has been. Now, coming to the balance sheet, Shopify currently has $2.4 billion in cash, $6.34 billion in cash equivalents, $1.9 billion in free cash flow, and only $1.11 billion in total debt. So this is a very clean balance sheet. Plenty of cash, strong free cash flow, and very little debt. And honestly, this is one of the main reasons the stock has been moving almost parabolically up and to the right. Now, from a technical perspective, at current levels, this is not an ideal entry point for me. Personally, I'm watching the $140 level, which lines up closely with the 200-day EMA. That's where I'd be much more comfortable starting a long-term position. Until then, I'm not forcing anything. Instead, I'll likely continue to sell puts to generate income because I'm fairly confident the market will pull back a bit before moving higher. I'd rather wait for a better entry setup than chasing strength. Now, let's look at the future growth drivers because this is where Shopify really stands out. Agentic commerce with AI tools like Catalog, Universal Cart, and Checkout Kit, the rapid adoption of its AI assistant sidekick, and continued expansion of Shopify Payments and ShopPay, all of which directly improve conversion and revenue. On top of that, strong international and B2B growth adds a long runway ahead. And when you put all of it together, AI and innovation, expanding monetization, and global scale, Shopify remains exceptionally well positioned for long-term investors. Alright, now let's move on to the third stock on the list, which is Intuitive Surgical, ticker symbol ISRG. At a high level, Intuitive Surgical is the global leader in robotic assisted surgery. They develop, manufacture, and sell the Da Vinci surgical systems along with the Ion endoluminal systems. These systems give surgeons significantly more precision, control, and flexibility, and they enable minimally invasive procedures, which means better outcomes for patients and faster recovery times. And here's the thing, this is not a crowded space. Intuitive Surgical basically owns the entire market. As of now, Intuitive Surgical has a market cap of about $290.9 billion and revenue is growing at roughly 22%. One important detail here is their large portion of their revenue comes from product sales, which creates a very strong recurring ecosystem over time as hospitals expand, upgrade, and service these systems. Using my valuation model, I'm seeing about 16% upside over the next 1 year and roughly 107% upside over the next 5 years. The reason I like Intuitive Surgical is because of its dominance in this sector. This is very similar to ASML in semiconductors. There is no real competitor that comes close to Intuitive Surgical in robotic assisted surgery. The switching costs are high, the technology moat is massive, and hospitals don't just swap these systems overnight. That kind of monopoly matters a lot in the long term. From a timing perspective, though I wouldn't chase it at current levels, personally, I would like to see the stock cool off a little bit, ideally closer to around $550 before getting back in. That would provide a much better risk to reward setup. But even if it takes time to pull back, I have no doubt this will be a long-term winner. Alright, next up is Robinhood, and I think most of you might already know this company pretty well. Robinhood Markets is focused on building a global financial ecosystem with a very clear goal. They want to become the #1 platform in wallet share for the next generation of investors and traders. And they are not just stopping at stock trading anymore. Robinhood is rolling out new products for active traders, expanding into banking and wealth management, and they are also pushing internationally, including some really interesting initiatives like tokenized equities. Robinhood currently has a market cap of around $105 billion, and this is the part that really stands out. Revenue growth is about 74%. That kind of growth is not normal for a company of this size. Most of their revenue comes from transaction-based income and net interest income, which has benefited massively from higher interest rates and increased platform engagement. Now, I know what some of you might be thinking. Robinhood is already up a lot last year. What's left? That's a fair question to ask. So let me walk you through why I still see a lot of runway here. First is their active traders. Robinhood is clearly positioning itself as the go-to platform for active traders by constantly rolling out new tools and features. As more active traders join the platform, trading volume increases and that directly translates into higher revenue. Second is their wallet share growth. Robinhood is not just trying to be a trading app, they want to be the place where the next generation keeps their money. Checkings, savings, investing, retirement, everything. The more products a consumer uses, the higher their lifetime value becomes. Third is the idea of a global financial ecosystem. Robinhood's international expansion, including tokenized equities, opens up entirely new markets and revenue streams. This reduces reliance on just US retail trading and makes the business much more diversified over time. And then there's the prediction markets business. This one surprised a lot of people. Prediction markets have already crossed $100 million in annualized revenue, and based on October volumes, this segment alone could reach a $300 million run rate. That's a perfect example of how new product lines can quickly become meaningful contributors. Now, based on all of this, my model is showing about 27% upside over the next 1 year and roughly 237% upside over the next 5 years. Technically speaking, the stock is currently trading around its 50-day EMA, which is okay if someone wants to start a small position. That said, if we ever see Robinhood closer to $100 level, I personally think that would be an excellent long-term entry point. So when I put everything together, explosive revenue growth, expanding product ecosystem, new revenue streams, and long-term demographic tailwinds, Robinhood absolutely earns its place on my list. Next up is Micron, and this is a name that comes up a lot whenever we talk about AI, data centers, and memory demand. Micron is a semiconductor company that focuses on memory and storage solutions, mainly DRAM and NAND. They also play a big role in high bandwidth memory or HBM, which is becoming absolutely critical for AI workloads. Their memory products are used everywhere like data centers, cloud infrastructure, mobile devices, client computing, and even edge computing. And the main reason Micron has been doing so well recently is simple. AI is changing everything, and memory is no longer just a component. It's become a strategic asset. I actually owned Micron last year and sold it for a nice profit at around $250, thinking it was way overextended. But the stock kept running after that, which looking back was one of the biggest mistakes I made last year. But that's okay, it happens. What matters now is finding the next good entry, and I'm absolutely looking to get back in on any pullbacks. Let's look at their business number as well. Micron currently has a market cap of about $382 billion and revenue is growing at roughly 45%, which is extremely strong for a company in a traditional cyclical industry. When you break down where the revenue is coming from, cloud memory is the largest contributor, followed by mobile and client, and then core data center and other segments. And here's how my model is looking at Micron. If they continue growing at this pace, I see about 52% upside over the next 1 year, which would put the stock around $500. And for the 5-year outlook, I'm being more conservative because memory is cyclical. I lowered the assumed growth rate to 20%, and even with that, my model is projecting around 150% upside in 5 years, which would take the stock above to $800. Let me also show you their balance sheet now. They have $9.68 billion in cash, $10.3 billion in cash equivalents, $12.4 billion in total debt, and $4.65 billion in free cash flow. That brings their net debt to negative $7.6 billion, which means they have more cash than debt. That is a very strong balance sheet, especially for a semiconductor company that needs to invest heavily in capacity. Moreover, Micron is making strong progress on long-term contracts with customers that include specific volume commitments. This helps smooth out some of the cyclicality that memory companies are known for. So when I put all of this together, strong AI tailwinds, improving demand visibility, disciplined capital spending, and a rock-solid balance sheet, Micron clearly earns its spot on my list. Alright, next up is Celsius, ticker symbol CELH. And this one is little different from the tech-heavy names we have talked about so far. Celsius operates in the energy drink space, but they are not trying to compete head-to-head with traditional energy drinks in the old way. Instead, they position themselves as a functional, better-for-you energy brand. Their portfolio includes Celsius, Alani Nu, and Rockstar Energy, and a big reason they have been able to scale so quickly is their partnership with PepsiCo, which gives them massive distribution power. Now, let's look at their numbers. Celsius has a market cap of around $13 billion and their revenue is growing at about 55%, which is extremely strong. Right now, North America is their largest revenue contributor by geography, and I personally have a small position in Celsius and I'm currently up about 184% on it, and I'm still holding it because based on my model, I still see 41% upside over the next 1 year and about 450% upside over the next 5 years, which might look very optimistic, but I'm not blindly assuming that happens. My realistic plan is to trim some profits if the stock gets close to $100, but until then, I'm letting it run. Now, let's look at the balance sheet as well, because this is where a lot of people get surprised. Celsius has $931.2 million in cash, $805.9 million in cash equivalents, $523 million in free cash flow, and $861.4 million in total debt. That brings their net debt to negative $875 million, which means they can actually have more cash than debt. So from a financial health perspective, there are no red flags here. And that's important because high growth consumer brands can sometimes struggle with cash flow, and Celsius is not in that situation. Now, let me tell you what can drive the next leg of growth for Celsius. First is strategic expansion through PepsiCo. This partnership allows Celsius to scale distribution much faster than they could do on their own. It also improves efficiency across sourcing, logistics, and shelf placement. Second is brand building. They continue to invest heavily in marketing, including campaigns like Celsius Live Fit Go, which strengthens brand awareness and loyalty. Third is their portfolio expansion. Celsius is not a one brand company anymore. As their portfolio grows, they can capture different segments of the energy and wellness market without diluting the core brand. And finally, Rockstar Energy. Rockstar has gone through a rough patch, but stabilizing and integrating Rockstar sourcing and production could become a meaningful growth driver in 2026. So when I step back and look at Celsius as a whole, strong revenue growth, a clean balance sheet, expanding distribution, and multiple brands under one single roof, I still see a company that has room to grow even after a big run. And now let's move on to the next stock on the list. And this one is actually very interesting, especially if you are looking for something a bit different from the usual big tech names. And that's Doximity, ticker symbol DOCS. Before jumping into the numbers, let me tell you what this company actually does, because once you understand the business, the numbers start to make a lot more sense. Doximity is essentially a professionally medical network built specially for US physicians and healthcare professionals. Think of it like a LinkedIn, but only for doctors. And not just networking, it's much deeper than that. Doctors use Doximity to connect with other physicians, collaborate, stay updated on medical research, and keep up with the latest industry news. But here's the thing, it doesn't stop there. Doximity also provides tools that doctors actually use in their daily workflow. Things like telehealth scheduling, digital facts, clinical references, and even documentation tools. So this isn't some optional platform people log into once a month. It's embedded into how healthcare professionals operate. Now, let's talk numbers. Doximity currently has a market cap of about $8.75 billion and their revenue is growing at around 20%, which is very solid for a company at this size. And their revenue comes primarily from pharmaceutical companies. These pharma clients use Doximity's platform for marketing and advertisement. But what's really driving growth right now is their AI optimized integrated programs. Now, let's get into my model. Based on my projections, which uses current EPS, expected annual EPS growth rate, and the current valuation, I see about 19% upside over the next 1 year and much more meaningful upside of 138% over the next 5 years. That would put the stock price somewhere around $110 in the long term. But here's the thing, none of that really matters if the balance sheet isn't strong. So let's look at that next. They have $169.2 million in cash, $878.3 million in cash equivalents, and total debt of just $11.2 million. When you add all of that up, their net debt comes to negative $1 billion. So basically, even if they decided to pay off all their debt today, they'd still be sitting on a massive pile of cash. On top of that, they are generating positive free cash flow of $312 million, which gives them flexibility, whether that's investing back into the business, expanding AI capabilities, or simply strengthening the balance sheet further. So when you put everything together, strong revenue growth, AI-driven monetization ramping up fast, a nearly debt-free balance sheet, and meaningful long-term upside for anyone looking for a high-quality stock under $50 with strong fundamentals and long-term potential, Doximity is definitely one to keep on their radar. Next up on the list is Nu Holdings, one of the most exciting fintech services coming out of Latin America. Nu Holdings is a digital banking platform focused primarily on Brazil, Mexico, and Colombia. As of Q1 2025, the company has grown its customer base to an impressive 119 million users, with 105 million in Brazil, 11 million in Mexico, and over 3 million in Colombia. What makes Nu so compelling is the opportunity. Latin America remains a largely underbanked region, and Nu is positioning itself to be the go-to financial platform by expanding access to simple, low-cost banking services. Now, let's talk about numbers. Nu Holdings currently has a market cap of $84.8 billion and revenue is growing at around 20% annually. The majority of that revenue comes from interest income and gains on financial instruments, which gives the business strong recurring cash flow. I personally own this stock and I'm currently up about 44%. More importantly, I'm still holding because my valuation model suggests about 37% upside over the next 1 year, and over 5-year period, that upside could reach 364%, potentially putting the stock around $81 per share. One of the biggest reasons I'm confident is the balance sheet strength. Nu has $12.48 billion in cash, $17.3 billion in cash equivalents, and generates $3.66 billion in free cash flow. Meanwhile, the total debt sits at just $1 billion. That gives the company roughly $28.7 billion in liquidity, which provides enormous flexibility to invest, expand, and scale the business. Overall, with strong financials, massive market opportunity, and a scalable business model, which is exactly why it remains a high conviction long-term hold for me. Next stock on the list is UiPath, a company operating right at the intersection of automation and AI. UiPath specializes in robotic process automation, or RPA, along with newer agentic automation solutions. In simple terms, their software helps organizations automate repetitive and complex business processes, which dramatically improves efficiency and productivity. Their technology is already being used across multiple industries and notably in the federal sector, where it's helping modernize legacy systems and improve mission readiness. For example, one of the world's largest investment management firms integrated UiPath with ServiceNow, Confluence, and specialized large language models, resulting in a 95% reduction in time to value and tens of millions of dollars in projected savings. UiPath is working closely with major technology leaders like OpenAI, Microsoft, Nvidia, and Snowflake. These collaborations significantly enhance UiPath's agentic automation capabilities. New integrations such as with Microsoft Azure AI Foundry allow UiPath agents to work seamlessly alongside Azure agents and models, expanding the platform's reach across key industries. I've actually done a dedicated video breaking down UiPath's full business model, so if you want a deeper dive, I highly recommend checking that one out. Now let's talk about their financials. The company has a very strong balance sheet with $737.5 million in cash, $743.6 million in cash equivalents, and just $82 million in total debt. On top of that, UiPath is already generating $311.5 million in free cash flow. This tells me we are looking at a high quality business that's still in the very early stages of its growth cycle. From a valuation standpoint, my model projects about 22% upside over the next year and roughly 185% upside over the next 5 years. If that plays out, the stock could reach nearly north of $50 per share. Put all of it together, strong financials, growing free cash flow, and massive upside from agentic automation, UiPath stands out as a strong, compelling long-term AI and automation play. And the final stock on the list is Pinterest, ticker symbol PINS. Pinterest operates as a visual discovery platform where users go to find inspiration, whether that's for home projects, fashion, travel, or business ideas. Unlike traditional social media, Pinterest functions more like a visual search engine, which gives it a very different level and powerful use case. The platform now has 578 million monthly active users and more than 50% of them are Gen Z, which is extremely important when you think about long-term growth. Pinterest has been heavily investing in AI-driven personalization and that's already paying off. Year to date, the company has seen a 230 basis point increase in search fulfillment rates, meaning users are finding what they are looking for more efficiently. From a monetization standpoint, Pinterest generates most of its revenue through advertising, and this is where things are getting really interesting. The company is expanding its performance advertising capabilities through the Pinterest Performance Plus suite, which is gaining strong traction, especially among mid-market advertisers. Even more importantly, lower funnel revenue flowing through Performance Plus campaigns has more than doubled since the end of last year, signaling improving ad efficiency and stronger ROI for advertisers. International growth is another major tailwind. Markets in Europe and the rest of the world are seeing accelerated revenue growth as Pinterest expands its sales efforts and rolls out lower funnel ad products globally. While the US and Canada remain the largest revenue contributors, international monetization is clearly catching up. Despite all this, Pinterest is still a relatively small company with massive growth potential. It currently has a market cap of about $18.5 billion, with revenue growing at roughly 16.7% annually and a global user base approaching 600 million monthly active users. Their balance sheet is another big advantage. Pinterest has $1.13 billion in cash, $2.67 billion in cash equivalents, and just $205 million in total debt. On top of that, the company is generating an impressive $1.12 billion in free cash flow. For a company of this size, producing over $1 billion in free cash flow, this is extremely impressive and gives management plenty of flexibility to invest and scale. From a valuation perspective, my model is projecting about 28% upside over the next 1 year and around 239% upside over the next 5 years, which could put the stock nearly $90 per share. Even technically, the setup looks really attractive. The stock is currently trading below its 200-day EMA on both the daily and weekly charts, which historically has provided strong long-term entry opportunities. Because of that, I'll be opening a position very soon in my portfolio. And that wraps up today's video. I also have another list of stocks with massive upside potential. I'll be making a separate video breaking those down. Let me know in the comments what you think about these stocks and whether you already own them or planning to add them. If you found this video helpful, make sure to like, subscribe, and turn on notifications. And thanks for watching, and I'll see you in the next one.